Here are my best stocks to buy right now. Let's do it. What's going on, everybody? My name is Matthew. Welcome back to my channel, and today, what are the best stocks to buy right now in my opinion? All the stocks I'm talking about today have to meet two criteria because we're being a lot more cautious. They either have to be one, at an irresistible valuation, or two, they might actually thrive given another economic shutdown. The first stock is more of an honorary mention because I don't actually own it yet and I'm still doing my due diligence, but I really wanted to put it on everyone's radar because the valuation could get very interesting, and that of course is one of today's criteria. So stock number one to research and keep an eye on is Callaway Golf, ticker ELY. I was actually looking at this stock a few months ago when trying to find stocks that catered to a wealthier demographic, as they seemed less financially affected by the illness, and perhaps with this recent drop, this is our golden opportunity. This stock is down big over the last few days after announcing a potential merger with Topgolf, the entertainment venue where you can golf, drink, and have fun. Now, before you say that Callaway, the high-end golf brand that sells clubs and golf apparel, has no business investing in an entertainment value where 50% of customers aren't even golfers, Callaway has actually been invested in Topgolf since 2006 with a 14% stake, and the CEO of Callaway has been on Topgolf's board since 2012, so he has seen the business grow firsthand for the past 8 years. This merger was a big deal to me because it brought down Callaway's price a lot, and it's a very exciting fundamental change to the company. Prior to the Rona, Topgolf was expected to IPO at a valuation of about $4 billion. Callaway could potentially acquire them for half that price at $2 billion. If you're looking long term, this could be a steal, but there are of course pros and cons. A big pro is that Topgolf did $1.1 billion in revenues in 2019, growing at a 30% compound annual growth rate for the past 3 years, thanks to their unique spin on driving ranges that were growing wildly in popularity pre-illness and their great business model. Topgolf is essentially keeping golf alive amongst the younger generations by turning golf ranges into event spaces. But not only are they gamifying their own spaces, they can actually gamify normal driving ranges. You see, Topgolf has a licensed product called Top Tracer. They license it out to driving range owners to make it more exciting and increase the appeal by gamifying the whole experience, letting you compete against friends or on virtual leagues. At the same time, every shot traced by Top Tracer is sent back to a central database at Topgolf, where they can then sell that information to golf manufacturers, or now maybe give it to Callaway to give them a competitive advantage. Top Tracer is really just a cherry on top to the amazing Topgolf business model, so they're only in the low single digits of market penetration with this part of their business. But here's the biggest con, their main problem: the debt. More specifically, about $525 to $555 million of it. And it doesn't help that Callaway already has a fair share of debt on its balance sheet. Building these huge driving ranges is very capital intensive, and right now they have about 50 locations, and they're actually going for 200 locations in the US and 450 locations globally. Moving deeper into the financial side of things, Moody's actually recently gave Callaway a B1 credit rating, which is the highest non-investable grade credit rating. This basically means Moody's thinks Callaway is at risk of defaulting on any loans. In other words, their financial situation is not too hot right now. And aside from the obstacles of the illness, obviously the health restrictions, there's another obstacle. Winter is coming. Golf, for obvious reasons, is a seasonal business. There are lower revenues in fall and winter as seen by these quarterly revenues, and they're stronger in spring and summer. I mean, you can already see it in the Google Trends for the search "golf courses near me." It's dropped off like a rock. So not only do they have the illness health restrictions, but also cold weather. If the merger does go through, pending shareholder approval, it will be completed in early 2021. So I just threw a ton of information at you, but the best part is that this is a video. You can rewind it if you want. So a lot to consider here. It could be a very, very interesting long-term play, but there are a lot of obstacles like the illness and restrictions, seasonality, and debt. So again, I'm not sure if we're going to buy this one yet, but if the price keeps dropping, it could meet our criteria of the irresistible valuation. But the last 3 stocks won't be this long, and they are stocks I'm likely buying in November. Stock number 2 is Canadian Solar, ticker symbol CSIQ or CSIC. Sustainable energy is the future, and I think exposure to renewables is really smart. And I think CSIC has one of the most attractive valuations in the industry. And I don't know who will win, again, not a political video, but if Biden is elected, the market has been anticipating an infusion of investments in clean energy, which sent the new solar ETF TAN up 123% this year alone. But not so fast. At the same time, UBS analysts has downgraded 4 solar stocks on Tuesday, the 27th of October. They downgraded SolarEdge, Jinko, Sunrun, and SunPower. Now this is where the valuation comes into play. These are the approximate PE ratios for each company, and obviously more goes into valuing a company than just their PE ratio, but this gives us a general idea. 74, 14, 45, and Sunrun isn't even profitable. Canadian Solar is at 8, which I think is very reasonable. I actually just posted a collaboration with Daniel Pronk, and he's been covering this stock for a really long time. So if you want more detail on this stock, check out our collaboration right here, or go check out his channel. If a video didn't just pop up right there, it's because you're early. The collab is posting later this week, so stay tuned. Stock number 3 is Webull. No, I'm just kidding. But for a limited time, if you open an account and deposit $100, you will get 3 free stocks. So if you're interested, there's a link in the description below. Let me know which ones you get. The actual third stock is Maxar Technologies, ticker symbol MAXR. I know I talk about this stock a lot, but new people watch my videos every time, and I want to get the word out on this one because I still think it's undervalued and misunderstood. Kind of like a lot of my jokes. I did not bring it up last month as a best stock to buy, but here we are again in the mid-20s with a PE under 6. To quickly recap, this stock is a growth turnaround play. Complications with management and one of their old satellites sent the stock crashing in late 2017 and early 2018, but new management stepped in and the stock is up over 360% since then. And I still think it's undervalued. Now what I've learned is that one of the most important things in a value investment is that you need a catalyst to make Wall Street take a second look at this stock and realize maybe they should reconsider. And for Maxar, not only will their Worldview Legion satellite and acquisition of Vricon start to bring in increased and impressive cash flows that should not go unnoticed, but the space industry as a whole is taking off, and I swear that pun was not intended. We have Elon Musk launching the Falcon 9 rockets with astronauts on board and successfully landing the rockets back on Earth. That was an event. We have Richard Branson getting closer to his first commercial flight with Virgin Galactic. And with the list of celebrities who own tickets for those flights, you bet that will be on the news. You've got Bezos with Blue Origin, and you've got headlines like these, with Q3 of 2020 being the largest quarter ever for space infrastructure, and 2020 already being the largest year on record for space infrastructure investments, with Q4 still to go. I believe space has already become investable, and as more of these headlines hit the news, we'll realize this is becoming part of our lives. I think space is going to be the next big megatrend like AI, and Maxar right now is my first play. I do not mind scooping up some shares here at all. Stock number 4, our last stock for today, is Teledoc, ticker symbol TDOC. This stock meets today's criteria of thriving even if we have another economic shutdown, because that would mean telehealth has once again become vital, as it already is. Of course, we would all rather have no Rona at all, but the stock does ultimately benefit from higher social restrictions. And recently, Teledoc officially merged with Levon Gaines. I've come around, I love that merger now. But it got clobbered. And honestly, I don't understand why this is getting beat down right now. If TDOC reaches 187, which should be about the same levels we saw when this merger was first announced, I will likely be loading the truck. They just reported amazing numbers, beating estimates, witnessing insane growth, and raising full-year expectations. And the company they just officially merged with, Levon Gaines, our fan favorite, also just reported amazing numbers, beating estimates as well, and seeing yet another profitable quarter. Yes, Teledoc has a bigger net loss from last quarter, but excluding transaction costs for the Vongo merger and transaction costs for the InTouch merger, it was a mere $10.7 million loss in Q3, and I see this as a win and forward progress towards profitability compared to their $20 million loss from Q3 1 year ago. Their balance sheet remains very strong and very healthy, and I think it is very survivable no matter what economic conditions we may face. I have a whole video covering Teledoc right here, so go check that out if you're curious about my whole thesis. So to recap, I do think we could see more downside, especially if we break through very important support levels on the indexes. But I'm not sitting on the sidelines completely. I'm nibbling, just nibbling on stocks that meet very specific criteria regarding valuations and survivability during another economic shutdown. In other words, I'm kind of buying stocks that I think would still do fine given the worst case scenario. And do I think we're going to crash, or do I think that we're going to see March lows again? No, I don't think so. But I am definitely staying very conscious of how much ammo I have left in my account. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and check out our quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. If you're watching at this point in the video, you are the real MVPs. Don't forget your peace and thank yous.